Greetings, my beloved clients and friends. Today I want to talk to you about Jeff Bezos and triple tax-free investing. So Jeff Bezos is a titan of American industry, and he basically rewrote the American Business Playbook. So I want to explain what I mean by that. So many of you that know me know that I'm a big fan of Benjamin Graham, the father of value investing, who wrote two great books, Security Analysis and The Intelligent Investor. And Security Analysis he wrote back in the 30s, and Intelligent Investor he wrote in 1949, and then updated every 5 years. The last one was written in 1970. So in those books, he kind of laid out a strategy for how to value a company, and he went off of the systems that were in place in the bond industry, because the bond investors were very academic, you could say, and at the time stock investors were more speculative, and he had lost money in the Great Depression, and so he wanted to get a more systematic approach to investing. So he looked at stocks as if they were bonds, and back then stocks paid higher dividend than bonds because stocks were viewed as more risky than bonds, and a stock dividend was not a contract. It was something that a corporation would announce every quarter. So obviously if there was more risk associated with stock dividends, the market would require a premium or a higher dividend. And a lot of his analysis was looking at that stock dividend and determining if it was a good company, using a lot of bond analysis. So, and he encouraged companies to pay out the majority of their earnings in the form of dividends. And so analysts learned to look at a company's dividends to determine if it was a good investment. And then, say after World War II, especially, even before that, but especially, companies started to look at growing more. More emphasis was on not a steady dividend, but on also growing the company. So in order for them to grow the company, they would have to pay out less of their earnings in dividends, keep some of it to be able to invest back into the company so that the company could grow, right? So, but if the company was able to grow, then it was good for shareholders because they would get appreciation on their stock price and a dividend, even if it was a lower dividend. So, for example, let's say a stable company was paying a 6% dividend on their stocks, but a growing company was only paying a 3% dividend on their stocks. But the stock was appreciating at 6 to 8%. So really that investor's getting 9 to 11% total return, even though he's getting a smaller dividend. So that was how growth companies looked at managing their earnings. Okay, keep some of it so we could grow the company. Well, then in the 80s and 90s, tech companies started to become popular. And a lot of those tech companies didn't pay any dividend, but they provided a lot of growth. Okay, so that was the next development. Companies that were growing a lot, giving their investors a high price appreciation, even though they paid no dividend. Okay, and then a company called Microsoft came out. Oh, so most of the tech companies, before I get into Microsoft, were still manufacturing companies. They manufactured chips, or they manufactured hardware, they manufactured, so they were really a tech manufacturing company. But then Microsoft came around and they didn't make anything. They just made software, okay? And software was very capital light. You didn't need to open a new factory or buy another any equipment, because software was just code, basically, right? So here comes Microsoft, and they didn't pay any dividend, and they were growing really quickly. And the capital expenses that were required to grow their business were things like R&D, research and development, or hire more labor, hire skilled software engineers, right? Or advertising. And those three expenses are for tax purposes, are current year expenses, okay? Compared to a typical manufacturing company, if they want to grow, they got to buy a building or buy a company or buy more equipment, and all those things are capitalized over the life of that of that asset. So they pay earnings, they buy these capital assets. Well, first they pay earnings, they pay taxes, then they buy these capital assets that they could amortize over 20 years. Compared to Microsoft, which was a software company, they have earnings and they spend it all on R&D or labor or advertising, and it brings their earnings down to zero because those are all current year expenses, okay? So Jeff Bezos comes around and he basically reinvents the American Business Playbook. He says, I'm going to build a company, and it's going to be capital light, and I'm not going to pay a dividend. All the money that I make in the company, I'm going to plow back into the company. And because I'm plowing back such a large amount back into my company in the form of R&D, labor, and advertising, I'm going to be able to get my taxes down to zero. For example, last year the company had $38 billion in free cash flow, and guess how much he spent in R&D? $38 billion, roughly. Okay, so how much taxes did he have to pay? Next to nothing. Okay, so, and he's been able to do this for the last 20 years. So if you had invested in Amazon, you have a 20%, it's been growing at about 20% a year for 20 years, consistently. So if you would have invested in Amazon, you'd have an investment that paid 20% a year on average. The company is not paying any taxes because they plow all the money back into the company in the form of current year expenses, R&D, labor, and advertising. And you don't pay any taxes because you don't receive any dividend income. And if you just buy and hold it, you don't pay any capital gains. So that was the beautiful invention that Jeff Bezos brought to us. And he rewrote the American Business Playbook. And there are other companies now that are following that playbook, especially software companies like Salesforce, Zoom, DocuSign, that they don't really have a product on the shelf. It's a thing that you just download off the web. So they don't need stores, they don't need inventory, they don't need a lot of those expenses. And the way they grow their business, R&D, advertising, and labor, which are all current year expenses. So we love that type of company. And analysts have a hard time understanding them because they read the same books that I read, right? Security Analysis and The Intelligent Investor, and they're looking for dividends and they're looking for earnings. And really, if you just take a step back and you could use the same analysis, you just move those three expenses off the income statement and over to the cash flow statement, and now it looks just like a manufacturing company. So it's not a hard step, but very few analysts have figured out how to make that step, and they're scratching their heads at these companies that have these ridiculous price to earnings or no dividends, and why would any invest in that? And they're really not, there's some that are very expensive still, but there's a bunch of them that are really not that expensive if you know what you're looking at. So we celebrate Jeff Bezos for that invention and for the other entrepreneurs that are following his steps that allow us to earn 20% triple tax free. So now a word about taxes. How does the government feel about that for a company like Amazon that doesn't pay any taxes? Well, for example, AOC ran him out of New York because he was going to put another headquarters in New York. And she said, well, he's not going to pay much in taxes, so we don't want him here. Which I think is very dumb, because indirectly he does pay a lot in taxes. He's going to give jobs to 3,800 people who are going to pay taxes. And where are those 3,800 people going to come from? The rolls of unemployment. They're going to come off of the government's payroll and go on to Jeff Bezos' payroll. He's doing the government a big favor. And you might say, well, not everyone that he hires is going to be unemployed when he hired them. Well, sure, some of them are going to come from another company, but guess what? That other company now has an opening because they lost an employee. And eventually it's going to trickle down to someone that doesn't have a job. So he's doing the government a big service by creating 3,800 jobs, okay? Also, there are many, many individuals and businesses that their livelihood is selling on Amazon. That's their business, which would not exist without Amazon. And they pay taxes, okay? And think about that headquarters that he was going to build there in New York. All the contractors and the construction workers, they were going to make an income and they were going to pay taxes. Think about Home Depot. They were going to go to Home Depot to buy the supplies to build that thing. They were going to pay taxes. And think about all the people, including me, that buy stuff on Amazon and we pay sales tax. That's tax, okay? So Amazon, and one more thing, Jeff Bezos, his big vision is to populate Mars. The moon, right? To get people on the moon, okay? The last time we went to the moon, the government paid for it. This time America is going to the moon and Jeff Bezos is paying for it. So that's an expense that's coming off of the government's income statement. So why wouldn't they give him a little bit of a break? In a certain way, he's generating a lot of taxes. So think about it the other way, invert it, as Charlie Munger likes to say. What if Amazon was gone all of a sudden? That'd be hundreds of thousands of people all of a sudden would go onto the government's payroll in the form of unemployment. A couple years back, Jeff Bezos said that they were hiring 100,000 people at Amazon, and he's done it more than once. And guess what? It moved the needle on the national unemployment numbers when Amazon hired 100,000 people. Okay, one company was able to move the needle on the national unemployment numbers just on one hiring spree. Imagine if that company was gone. How would that affect unemployment, right? Yeah, some of those people would find another job, but eventually those would trickle down to being on the government's payroll. And he pays health care for them, for his employees, so the government doesn't have to pay that health care, right? He provides retirement benefits for the employees, so it's a less of a burden on the government. So I'm not too upset as a taxpayer that Amazon doesn't pay much in taxes, because they take a lot of the burden off of the government in other ways, and money ends up in the government's coffers in other ways. So today I just want to celebrate Jeff Bezos, a titan of American industry, for inventing the 20% triple tax-free investment, and the other entrepreneurs that are following in his footsteps. We like those companies. We look for them, and the great ones we want to add to our portfolio. Okay, hope you guys enjoyed that. Hope you have a great day.